Money moves the world, but people move money. And among those people, a rare few don't just play the game. They create it. They are the architects of empires, the whisperers of billion-dollar deals, the ones who see patterns in chaos and opportunities in fear. Their names echo through boardrooms, trading floors, and late-night phone calls that decide the fate of entire industries. Welcome to Book in 20, where we break down the most powerful books on business, psychology, and success, transforming decades of wisdom into minutes of actionable insight. Let's dive in. October 13th, 1998, 3:47 a.m. A phone rings in a Manhattan penthouse. The man who answers has been awake for hours, pacing, calculating, preparing for this exact moment. On the other end, his final competitor, the last obstacle standing between him and a $10 billion media empire. The conversation lasts exactly 4 minutes. When it ended, Sumner Redstone, a 73 years old and outbid by nearly every analyst's projection, has just acquired Paramount Pictures in the most dramatic corporate battle of the decade. His board thought he was insane. Wall Street said it was impossible, but Redstone understood something they didn't. In the world of billion-dollar deals, psychology beats mathematics. Timing beats intelligence, and absolute conviction beats everything. Before we go any further, hit that subscribe button right now. Why? Because over the next 35 minutes, you're about to learn the exact strategies used by 9 individuals who collectively orchestrated over $500 billion in deals. And this is just the beginning of what we're building on this channel. Welcome to the ultimate deep dive into Daniel J. Cadleck's Masters of the Universe, the book that pulls back the curtain on America's greatest dealmakers. These aren't just wealthy executives, they're architects of modern capitalism, from hostile takeovers to billion-dollar turnarounds, from media empires to activist investing. You're about to discover the blueprint they used to dominate. Drop a comment right now telling us what country you're watching from. We've got viewers from over 67 countries, and we want to know, were you tuning in from New York, Texas, Madrid, Italy, Washington, London, Lagos, Mumbai, Singapore? Let us know below in the comment section. This is Masters of the Universe. Let's begin. Part 1. The Rise of the Dealmakers. Before we meet our 9 masters, you need to understand what made the 1980s and 90s the golden age of deal-making. Wall Street was transforming. Regulations were loosening. Junk bonds were making hostile takeovers possible. Technology was accelerating information flow. And a new breed of executive was emerging, one that saw companies not as institutions to be preserved, but as assets to be optimized, combined, or dismantled for maximum value. But here's what separates this from every other business book you've read. Cadleck didn't just study deals, he studied the people. He spent years interviewing these legends, analyzing their wins and their losses, their triumphs and their failures. And he discovered something remarkable. The truly great deal makers weren't just opportunists riding a wave. They were strategists who understood 3 fundamental principles that most people never learn. Principle 1. Every company has hidden value that markets haven't recognized yet. The master's job is to unlock it. Principle 2. Timing is everything. The best deal in the world executed at the wrong moment is worthless. Principle 3. Psychology and relationships determine outcomes more than spreadsheets ever will. Now, these weren't the smartest people in finance. They weren't always the most educated. Several didn't even go to Ivy League schools. But they shared something far more valuable, an almost supernatural ability to see around corners, to understand human nature at its deepest level, and to execute with absolute conviction when everyone else was paralyzed by doubt. Here's a question for you. What's one business deal or decision you've made that everyone told you was crazy, but turned out to be brilliant? Drop it in the comment section. I read every single one of them, and the best stories get featured in upcoming videos. Over the next 25 minutes, we're going deep into 9 masters. 9 philosophies, 9 different paths to the absolute top of the financial universe. And don't click away yet, because the final master's story contains a lesson that will completely change how you think about competition and strategic vision. Part 2, The 9 Masters. 1. Hugh M.C. Cole, the Empire Builder. Our first master grew up in North Carolina with a simple philosophy that his Marine Corps father drilled into him every single day. Think big, or go home. Hugh M.C. Cole took over a small regional bank called NCNB, North Carolina National Bank, and transformed it into what would eventually become Bank of America, one of the largest financial institutions on planet Earth. But here's what made M.C. Cole different from every other banker of his era. While they were cautious and conservative, playing not to lose, M.C. Cole was aggressive, playing to dominate. He didn't wait for opportunities, he created them. Strategic expansion through relentless acquisition. M.C. Cole understood something crucial that most bankers missed. In banking, scale equals power. The bigger you are, the better rates you negotiate, the more leverage you command. The more attractive you become to both customers and shareholders. So he went on what can only be described as a calculated buying spree. Throughout the 1980s and 90s, NCNB swallowed bank after bank after bank, small regional players, struggling institutions, even healthy competitors who didn't see him coming. Each acquisition was meticulously calculated to expand geographic reach or add specific capabilities. But the defining moment, the move that changed everything? In 1988, the oil crisis hits Texas. Banks are failing left and right. The FDIC is desperate to find someone, anyone, to take over these toxic assets. Every major bank in America says no. Too risky, too complicated, too far from home. M.C. Cole says yes. He flies to Texas, walks into negotiations with the federal government, and emerges with an incredible deal, billions in assets backed by government guarantees. Overnight, NCNB transformed from a regional player into a national powerhouse. That boldness, that willingness to sprint toward the fire while everyone else was running away, defined his entire career. M.C. Cole famously said, "I don't believe in friendly mergers, I believe in conquest. You're either the wolf or the sheep, and I prefer to be the wolf. Vision without courage is just daydreaming." M.C. Cole proved that in business, as in war, momentum is everything. While your competitors are analyzing data and debating in conference rooms, you strike. Think about Amazon's relentless expansion into seemingly unrelated markets. Cloud computing, streaming, groceries, healthcare, advertising. That's Cole's playbook. Use your dominance in one domain to fund aggressive expansion into adjacent territories before competitors even realize there's an opportunity. If you're getting value from this breakdown, smash that like button. It tells YouTube to share this video with more people who need to hear these strategies. 2. Sandy Weill, the architect of giants. If M.C. Cole was about conquest, Sandy Weill was about construction. Weill built Citigroup, at its peak, the largest financial services company in the entire world, through a 30-year masterclass in strategic mergers and integration. But Weill's genius wasn't just buying companies. Any billionaire with access to investment banks can do that. Weill's gift was seeing how different financial services could be integrated to create an ecosystem more valuable than the sum of its parts. He started with a tiny brokerage firm. Then he acquired insurance companies, then investment banks, then commercial banks. Each move built on the previous one. Each acquisition added a new capability that made the entire ecosystem exponentially more powerful. Think of it like building with Lego blocks, except each block costs billions of dollars, and one wrong placement could destroy everything. The defining moment. In 1998, Weill orchestrates a $70 billion merger between his company, Travelers Group, and Citicorp. Now, this wasn't just big. This was revolutionary. At the time, Depression-era laws, specifically the Glass-Steagall Act, actually prohibited this exact kind of merger between insurance, investment banking, and commercial banking. Weil did it anyway. He was so confident in the deal's strategic value that he bet the entire future of his company on Congress changing the law rather than forcing the merger to be unwound. He was right. Within 18 months, Glass-Steagall was repealed. His illegal merger became the model for modern financial services. Weil's philosophy: if you want to do something that's never been done, you can't follow the rules that already exist. Great deal makers don't just work within the system, they change the system itself. Weil understood that true vision sometimes means betting on how the world will be, not how it is today. But there's a critical cautionary tale here. Citigroup eventually became too complex, too sprawling, too difficult to manage. After the 2008 financial crisis, it had to be partially dismantled. The very integration that made it powerful also made it fragile. Integration is powerful, but simplicity is sustainable. Weil's early career showed brilliant synergy creation. His later years showed the dangers of overexpansion and complexity. The sweet spot: building an ecosystem where each piece genuinely strengthens the others, like Apple's hardware. Software services integration, not just acquiring assets for the sake of size and ego. Do you think Citigroup's collapse proves Weil was wrong, or just that his successors couldn't execute his vision? Drop your take in the comment section. 3. Stephen Bollenbach, the restructuring surgeon. While MC Cole conquered and Weil built empires, Stephen Bollenbach performed surgery. Corporate surgery, the kind that saves lives, or ends them permanently. Bollenbach was the absolute master of corporate restructuring, taking bloated, underperforming companies and making them lean, focused, and brutally efficient. His career reads like a tour of American corporate distress. He restructured Marriott. He resurrected Hilton Hotels. He helped Donald Trump avoid bankruptcy in the early 90s. He orchestrated Disney's acquisition of Capital Cities ABC. Everywhere Bollenbach went, value appeared as if by magic. But it wasn't magic. It was precision, radical simplification, and financial engineering. Bollenbach had what can only be described as X-ray vision for corporate structure. He could look at a balance sheet and instantly see which divisions were creating value and which were destroying it. Then he had the courage and the political skill to cut away everything that didn't serve the core mission. No sentiment, no legacy thinking, just ruthless optimization. The defining moment. In 1992, Marriott Corporation. The company was drowning in debt from overexpansion into real estate. Bollenbach engineered one of the most controversial corporate restructurings in American history. He split the company in two. One entity got all the valuable hotel properties and the Marriott brand. The other got all the debt and the struggling real estate assets. Shareholders loved it. The stock soared. Bondholders sued, claiming they'd been robbed. Legal battles raged for years. But it worked. Marriott survived and eventually thrived. Without Bollenbach's surgical precision, the entire company would have collapsed. Bollenbach's quote: "Most companies don't fail because they're doing the wrong things. They fail because they're doing too many things." Sometimes creation comes through subtraction. Most executives want to add new products, new divisions, new initiatives, new innovation. Masters like Bollenbach understand that focus and efficiency often create more value than expansion ever could. The most powerful question in business isn't what should we start doing, it's what should we stop doing. Look at how Netflix made the brutal decision to abandon its DVD business, which was still profitable, to go all in on streaming. Or how Apple killed the iPod when the iPhone made it redundant. Or how Amazon shut down dozens of experiments that weren't working. That's Bollenbach's philosophy, ruthlessly eliminating anything that distracts from your highest value activity, even if it's currently making money. Here's a challenge for you. What's one thing in your business or career that you need to stop doing immediately? Comment below. Let's hold each other accountable. 4. Carl Icahn, the raider who became a reformer. Now we enter completely different territory. Carl Icahn didn't build companies. He didn't merge them or restructure them. He attacked them. Icahn pioneered what we now call activist investing, buying large stakes in underperforming public companies, then forcing management to make changes that unlock shareholder value. In the 1980s, the media called him a corporate raider, a barbarian, a destroyer of American business. Today, he's seen as a corporate governance reformer, a champion of shareholder rights. The strategy never changed, only the perception did. Here's how it works. Icahn identifies companies trading below their intrinsic value, usually because management is comfortable, complacent, and protecting their own interests instead of maximizing shareholder returns. He accumulates shares, not enough to trigger immediate disclosure requirements, but enough to be dangerous. Then he goes public. Press releases, interviews, proxy battles. He proposes radical changes: fire the CEO, sell underperforming divisions, return cash to shareholders, break up the company entirely. Sometimes he wins control. Often, management just buys him out at a premium to make him disappear. Either way, Icahn profits. The defining moment? TWA, 1985. Icahn launched a hostile takeover of the struggling airline, fought off competing bids from Frank Lorenzo and others, and won control. He then spent 8 contentious years restructuring the company, battling unions, selling assets, cutting costs, and eventually taking it private. Did it work financially for Icahn? Absolutely. He made hundreds of millions. Did it work for TWA's long-term health? That's significantly more complicated. But here's what made Icahn a master, and why he's still dominating deals in his late 80s. He understands leverage better than almost anyone alive. Not financial leverage, psychological leverage. Icahn recognizes that in public companies, there's often a profound disconnect. Management runs the company, but shareholders own it. And too often, management serves themselves first, collecting massive salaries, building empires, protecting their positions, while shareholder value stagnates. By concentrating ownership and demanding accountability, Icahn forces change. Icahn's philosophy: when most investors, including the pros, all agree on something, they're usually wrong. Information asymmetry and misaligned incentives create opportunities. Icahn built his fortune finding situations where the people making decisions don't bear the consequences of those decisions. It's not pretty, it's often brutal. Thousands of employees lose jobs, executives lose power. But it's also how capitalism is supposed to work. Capital flows to its most productive use, not its most politically comfortable use. Listen, you don't need billions to use this principle. Look for situations in your own career or investments where incentives are misaligned, where the people making decisions don't experience the consequences. In companies, in partnerships, in politics, even in personal relationships. Then either fix the incentive structure or don't participate. Is Carl Icahn a hero who fixes broken companies or a villain who destroys them for profit? Drop your vote and why you think that way. 5. Gary Wilson, the distressed asset specialist. While Icahn attacked healthy companies that were underperforming, Gary Wilson specialized in companies that were actually broken. Distressed assets, bankruptcies, corporate disasters. The investment opportunities that made everyone else run for the exits. Wilson's career proves one of the most counterintuitive truths in finance. The best time to invest is often when everyone else is in full panic mode. He cut his teeth at Marriott under Stephen Bollenbach, learning the dark arts of financial engineering and corporate restructuring. Then he moved to Disney in the mid-1980s, when the company was vulnerable to hostile takeovers and struggling creatively. Walt had been dead for 20 years. The company was producing box office flops. Theme park attendance was stagnating. Activist investors were circling. Disney was dying. As Disney's CFO, Wilson helped architect one of the most spectacular turnarounds in corporate history. He structured the deals that brought in Michael Eisner and Frank Wells as CEO and president. He engineered the financial strategies that funded Disney's renaissance, the films, the theme park expansions, the acquisitions that transformed Disney into the media empire it is today. Then, just as Disney was soaring, Wilson did something unexpected. He left. He moved to Northwest Airlines, just as it was sliding toward bankruptcy. Again, turnaround. Again, massive value creation from absolute chaos. Wilson understood something most investors can't stomach. Distressed assets trade at massive discounts not because they're worthless, but because they're risky and complex. Most investors can't handle the uncertainty. They can't operate in chaos without panicking. They can't tell the difference between a company that's permanently broken and one that's temporarily distressed. But if you can see through the chaos to the underlying value, and you have the actual operational skills to execute a turnaround, you can buy dollars for dimes. At Disney, Wilson engineered a brilliantly complex financial strategy that simultaneously protected the company from corporate raiders while funding massive investment in theme parks, hotels, and film production. Wall Street thought Disney was finished, that the magic was gone forever. Wilson saw a sleeping giant with the most valuable intellectual property on earth. Wilson's insight: everyone wants to invest in success, but fortunes are made investing in potential. Crisis creates opportunity, but only for those who can operate in chaos without losing their minds. Wilson succeeded not just because he was willing to invest in distressed companies, but because he actually knew how to run airlines and entertainment companies. He had operational expertise, not just financial courage. That combination is rare. That combination is valuable. Whether it's real estate during market crashes, technology companies during industry disruption, or even personal career moves, the highest returns often come from going toward problems that scare away competition. But you need genuine skill, not just courage. Wilson succeeded because he combined analytical rigor with operational excellence. Be honest in the comments. Would you have invested in Disney in 1984? Or would you have thought the company was past its prime? Let's see who has the contrarian mindset. 6. Ted Forsman, the principled contrarian. In an era defined by aggressive leveraged buyouts, junk bond financing, and the philosophy of greed is good, Ted Forsman stood completely apart. Not because he avoided LBOs. His firm, Forsman Little, pioneered the entire industry, but because he did them differently. While competitors like KKR and others were loading companies with massive debt using junk bonds to finance increasingly risky takeovers, Forsman insisted on something radical: discipline. He used less leverage. He focused on companies with strong, predictable cash flows. He avoided hostile deals. He prioritized creating value over extracting it. His peers on Wall Street called him naive, overly cautious, leaving money on the table. Forsman called them reckless gamblers playing with other people's money. History proved him right. The defining moment? In 1989, the RJR Nabisco deal, immortalized in the book and film Barbarians at the Gate. This became the ultimate symbol of 1980s excess. $25 billion deal, financed almost entirely with debt, with competing bids that spiraled completely out of control as egos overtook business judgment. Forsman Little bid against KKR, but when the price exceeded what any rational analysis could justify, Forsman did something his competitors couldn't. He walked away. He publicly warned that deals this heavily leveraged, done at these inflated prices, would end in disaster. Wall Street laughed. KKR won the deal in a blaze of glory. 3 years later, when the junk bond market imploded, many of those aggressive LBO firms collapsed or suffered catastrophic losses. Forsman's more conservative approach meant his portfolios survived intact and actually thrived. Forsman believed that leverage is like fire, incredibly useful when controlled, catastrophically destructive when it gets out of hand. Use it wisely, and you accelerate returns. Use it recklessly, and you incinerate value and lives. More importantly, he believed in creating value through operational improvement, not just extracting it through financial engineering. When Forstmann Little bought companies, they improved operations, invested in growth, treated employees fairly, and built for the long term. Forstmann's famous quote, "Real excellence comes from discipline and patience, not from leverage and luck." The lesson: in a world obsessed with maximizing short-term returns through aggressive tactics, Forstmann proved that discipline beats cleverness over the long run. He also stood for something many dealmakers completely ignored: character. He was known for treating employees fairly during buyouts, for honoring commitments even when not legally required, for building relationships based on trust rather than just leverage and contracts. That wasn't weakness. It was strategic wisdom. Look around at today's financial landscape: cryptocurrency speculation, zero interest rate financing, growth at all costs startups burning billions, aggressive SPACs and meme stock mania. Forstmann's philosophy feels almost revolutionary in this environment. Build real businesses. Use leverage sparingly. Prioritize long-term value creation over short-term extraction. Make decisions you can defend not just legally, but ethically. This isn't idealism, it's pragmatism. Companies built on unsustainable foundations eventually collapse. Forstmann understood that time and compounding favor the disciplined. If you're still with me at this point, you're exactly the kind of serious learner this channel is built for. Subscribe right now so you don't miss what's coming next. 7. Joe Rice, the spin-out specialist. Most of our masters built value through acquisition or restructuring. Joe Rice did the exact opposite. He created value through separation. Rice pioneered the spin-out strategy, identifying valuable divisions buried inside larger corporations, then splitting them off as independent companies where their true potential could finally be realized. Think of it like this. Imagine a thoroughbred racehorse forced to pull a plow. It's still valuable, but it's being used completely wrong. Its potential is being wasted. Rice's genius was finding those racehorses and setting them free. Why does this work? Because conglomerates systematically hide and destroy value. A brilliant software division inside an old-school industrial company gets starved of resources and attention. A high-growth consumer brand inside a sleepy holding company trades at the parent's depressed valuation multiples. The assets are valuable. The strategy is sound. But the structure is wrong. Rice recognized that sometimes the most valuable thing you can do is subtract rather than add. Breaking things apart can create more value than combining them ever could. The defining moment? At Clayton and Dubilier, Rice orchestrated multiple high-profile spin-outs across different industries. He'd identified divisions that were undervalued and underperforming only because of corporate neglect. Then he'd negotiate to buy them from the parent company at a discount, because the parent didn't fully recognize their value. Once independent, with focused management, clear strategy, and proper capital allocation, these businesses transformed. Companies that had languished for years as corporate divisions became dynamic growth businesses within months of independence. Rice looked for 3 specific conditions. First, strong fundamentals. The business itself had to be sound: good products, loyal customers, defensible market position. Second, corporate constraints. The business was underperforming specifically because of bureaucracy, misaligned incentives, or resource starvation from the parent. Third, market mispricing. The public markets would value an independent company significantly higher than the same business as a corporate division. When all 3 aligned, Rice struck. Rice's philosophy: freedom is the ultimate catalyst for performance. Give talented people autonomy and watch them fly. Corporate bureaucracy, competing priorities, and resource misallocation. often destroy more value than any external competitor ever could. Sometimes the most valuable strategic move is liberation, giving talented people the freedom to execute without layers of corporate interference. Modern application. Think about PayPal's famous mafia of alumni who went on to found or lead LinkedIn, YouTube, Yelp, Tesla, SpaceX, and dozens of other billion-dollar companies. Was PayPal better off keeping all that talent under one roof? Or did more value get created by letting them spin out and build independent empires? Or consider how massive conglomerates like General Electric eventually broke themselves apart when the market finally demanded focus over sprawl. Rice was ahead of this trend by decades, recognizing that focus and independence often beat scale and synergy. Question for the comments. What's a major company today that you think should be broken up into separate businesses? Tell us why. 8. Henry Silverman, the turnaround artist. Henry Silverman built an empire by doing what many thought was literally impossible, turning chronic losers into consistent winners. His career was a masterclass in corporate reinvention, proving that very few businesses are actually unfixable, they're just poorly managed. Silverman's greatest creation was HFS Incorporated, later renamed Cendant, which became one of the largest service companies in the world through aggressive acquisition and systematic turnaround of struggling franchise businesses. He bought what everyone else avoided: fading hotel chains, struggling real estate brokerages, unprofitable car rental companies. Everyone else saw declining brands and terminal problems. Silverman saw valuable assets that were simply being managed incorrectly. Silverman understood that most businesses don't fail because their model is broken. They fail because their execution is broken. The product is fine, the market exists, the brand still has recognition. What's broken? Operations, marketing, technology, management, systems. Fix those, which is hard work but straightforward, and suddenly a hopeless loser becomes profitable. He also recognized the strategic brilliance of franchising. By converting company-owned operations into franchises, he shifted operational risk to individual operators while collecting stable, predictable franchise fees. The defining moment? Early 1990s. Silverman took control of hospitality franchise systems, which owned iconic but fading American hotel brands, Days Inn, Howard Johnson, Ramada. These weren't just struggling, they were dying. Outdated properties, terrible customer experiences, reputations in free fall. Every consultant said the same thing: these brands are finished. Shut them down or sell them for parts. Silverman saw something different: valuable real estate, established customer recognition, operational problems that could be systematically fixed. He restructured relentlessly, closed the worst performing locations, upgraded standards across the entire system, invested heavily in technology and central services. Most importantly, he gave franchisees the tools, training and support to actually succeed. Within 5 years, HFS was one of the fastest growing companies in America. Those dead brands were generating hundreds of millions in profit. Silverman's insight: bad companies are often just good companies being run badly. Change the management, and you change everything. Most businesses don't fail because of external competition or bad ideas. They fail because of internal dysfunction, poor leadership, bad systems, wrong incentives, execution failure. Silverman had the operational expertise to diagnose what was actually broken and the management skill to implement solutions systematically. He also understood timing brilliantly: buy businesses when they're cheap and unloved. Fix them systematically. Then sell or merge when the market finally recognizes their value. This is exactly how private equity operates today: buying underperforming businesses, installing better management, improving operations, then selling at a profit 3 to 5 years later. Or, think about great turnaround CEOs: Satya Nadella at Microsoft, Bob Iger's return to Disney, Steve Jobs coming back to Apple in 1997. The assets were always there. The brand was always there. The market opportunity was always there. What changed? Leadership, strategy, and execution. Silverman proved that reinvention is always possible if you combine clear vision with operational excellence and systematic execution. Comment below. What's a company you think just needs better management to be great again? Let's crowdsource some turnaround opportunities. 9. Sumner Redstone, the media mogul. Our final master operated in a completely different arena, media and entertainment, and he did it with a level of audacity that made even the other masters look cautious. Sumner Redstone built one of the world's most powerful media conglomerates, Viacom, through a combination of strategic vision, financial daring, and sheer, unbreakable willpower. Redstone started with a regional chain of drive-in movie theaters that his father owned. Nothing glamorous, nothing that suggested he'd eventually control a media empire reaching hundreds of millions of people globally. But he built that small theater chain into national amusements, then used that as a platform to acquire first Viacom, then Paramount Pictures, then CBS, and ultimately control over MTV, Comedy Central, Nickelodeon, and countless other properties. At its peak, Redstone's empire touched virtually every American household. Through cable television, film, and eventually digital media, Redstone understood something fundamental that many media executives missed. Content is king, but distribution is power. He built a vertically integrated empire that controlled both what people watched and how they watched it. He owned the studios making the shows, the networks broadcasting them, and in many cases, the cable systems delivering them to homes. That's not just business strategy, that's chess while everyone else is playing checkers. The defining moment? In 1994, Redstone launched a hostile takeover bid for Paramount Pictures, competing against Barry Diller, one of the most powerful and respected media executives in history, and QVC in what became one of the most dramatic, expensive, and public corporate battles of the entire decade. The bidding war escalated rapidly. Banks doubted Redstone could finance a deal that massive. Wall Street analysts said he was overextending dangerously. His own board questioned his judgment. Diller had more cash, better relationships, seemingly every advantage. Redstone pressed forward anyway. He outbid Diller through sheer determination and creative financing. He closed the deal, and he proved that boldness, backed by genuine strategic vision, can overcome seemingly impossible odds. Redstone's famous declaration, "Content is king, and Paramount has content. Everything else is just distribution, and distribution without content is worthless." Strategic vision requires absolute conviction. Redstone didn't just want to own media companies for ego or status. He had a clear thesis about how the industry would evolve. He bet that as distribution channels multiplied, from broadcast to cable to satellite to internet, premium content would become increasingly valuable. Whoever owned the best content franchises would generate returns for decades across multiple platforms. He was right. Shows like SpongeBob SquarePants, the Star Trek franchise, MTV's reality programming, these generated billions in value across television, film, merchandise, streaming, and formats that didn't even exist when Redstone bought them. But Redstone also demonstrated the strategic power of leverage, not just financial, but strategic leverage. He used existing cash-generating assets to finance new acquisitions. Each success funded the next move. Each platform strengthened the others. Think about how Disney used its theme parks and classic intellectual property, stable, cash-generating assets, to finance the acquisitions of Marvel, Pixar, Lucasfilm, and ultimately launch Disney+. That's pure Redstone strategy. Use cash cows in mature markets to fund expansion into high-growth opportunities, then leverage the content across every possible platform. Or consider how Netflix evolved from licensing other people's content to producing its own, then became a global distribution powerhouse. That's the vertical integration Redstone pioneered decades earlier, controlling multiple layers of the value chain to maximize both profits and strategic control. Redstone also demonstrated something else crucial: longevity and persistence. He was 71 years old when he won the paramount battle. Most people are thinking about retirement at that age. Redstone was launching the most aggressive phase of his career. He remained active in business into his 90s, proving that strategic vision and competitive fire don't have expiration dates. Redstone's philosophy summed up: in the media business, if you're not thinking 10 years ahead, you're already obsolete. The final lesson from Redstone? In media, as in technology, as in every rapidly evolving industry, the future belongs to those who can see around corners and have the courage to bet big on their vision, even when everyone thinks they're crazy. Alright, if you've made it this far, 28 minutes deep, you're part of the 5% who actually finish long-form content. That tells me you're serious about mastering these strategies. Hit subscribe right now and turn on notifications, because we're just getting started with this level of depth. Part 3. Universal Principles of the Masters. 9 Masters. 9 different industries. 9 distinct strategies. But as Daniel Kadlec discovered through years of research and interviews, they shared a common DNA, a set of universal principles that transcended individual deals and defined their collective success. Let's pull it all together. Principle 1. Vision over analysis. Every single one of these masters operated from vision, not from spreadsheets. They didn't wait for data to prove their thesis. They saw opportunities before the numbers made them obvious. MC Cole saw a national banking empire when he was running a regional North Carolina bank. Redstone saw a global media powerhouse when he owned drive-in movie theaters. Here's the key. Analysis tells you what has been. Vision tells you what could be. The masters used analysis to validate and refine their vision, never to replace it. They understood that by the time the data proves an opportunity, the opportunity is already gone. Your takeaway: develop the courage to act on conviction before you have perfect information. The biggest opportunities are invisible to spreadsheets. Principle 2. Timing is everything. Notice how many of these defining moments happened during crisis or transition. MC Cole bought Texas banks during the oil crisis. Wilson invested in Disney when it was vulnerable. Forstmann won by walking away when prices got irrational. The pattern: the masters didn't just make good decisions, they made good decisions at the right moment. They understood market cycles. They recognized when assets were mispriced. They had the patience to wait for their moment, and the decisiveness to strike when it arrived. Your takeaway: speed without timing is recklessness. Patience without action is paralysis. Master both. Principle 3. Relationships trump transactions. Here's something you might have missed. Almost every major deal involved relationships built over years or even decades. Weil's ability to merge Travelers and Citicorp came from relationships with regulators and board members. Redstone's victory over Diller was partly because he'd built trust with Paramount's leadership. These weren't just transactions. They were the culmination of years of relationship building, reputation management, and trust creation. The insight: in the world of billion-dollar deals, character and relationships often matter more than capital. People do deals with people they trust. Your takeaway: invest in relationships as heavily as you invest in skills. Your network isn't about collecting contacts, it's about building genuine trust over time. Principle 4. Emotional control in chaos. Every single one of these masters faced moments of extreme pressure where emotions could have derailed everything. Think about Redstone during the Paramount battle, outbid, doubted by his own board, watching his competitor seemingly win. Lesser people would have either quit or made desperate, irrational moves. He stayed calm, stayed strategic, and won. Or Forstmann walking away from RJR Nabisco while his ego screamed to win at any cost. The pattern: the masters felt fear, doubt, and pressure just like everyone else. But they didn't let those emotions control their decisions. They had what psychologists now call emotional regulation, the ability to feel emotions without being controlled by them. Your takeaway: the person who can stay rational when everyone else is panicking has an almost unfair advantage. Practice emotional discipline like you'd practice any other skill. Principle 5. Calculated risk, not reckless gambling. Here's a crucial distinction. Every master took huge risks, but they were calculated risks. McColl's Texas expansion was bold but backed by federal guarantees. Weil's illegal merger was risky but based on deep analysis of political trends. Icahn's hostile takeovers were aggressive but grounded in fundamental value analysis. The difference between them and the dealmakers who crashed? The masters understood their downside. They structured deals to survive worst-case scenarios. They used leverage as a tool, not as a drug. Forstmann's wisdom applies to all of them. Discipline beats cleverness. Every single time. Your takeaway: big bets are necessary for big wins. But big bets without understanding your downside is just gambling. Always know what happens if you're wrong. Principle 6. Operational excellence over financial engineering. Notice something interesting. The masters who focused purely on financial engineering, loading companies with debt and extracting value, often saw their empires collapse. The ones who combined financial sophistication with genuine operational improvement, actually making companies better, not just restructuring them on paper, built sustainable success. Bolenbach restructured and improved operations. Silverman didn't just buy struggling franchises, he actually fixed them. Wilson didn't just invest in distressed assets, he knew how to run airlines and entertainment companies. The pattern: financial tricks can create short-term wins. Operational excellence creates long-term empires. Your takeaway: master the fundamentals of actually running businesses, not just trading them. Real value creation comes from making things genuinely better. Principle 7. Conviction without arrogance. Finally, and this might be the most subtle but important principle, the masters balanced absolute conviction in their vision with genuine intellectual humility. They were confident enough to bet billions on their thesis, but humble enough to adjust when reality proved them wrong. Weil's Citigroup eventually proved too complex, and later leaders lacked the humility to admit it. Redstone's media empire thrived for decades, but even he couldn't have predicted streaming would disrupt everything. Be convinced in your strategy, but flexible in your tactics. The world changes. New information emerges. Adaptation isn't weakness, it's intelligence. Your takeaway: hold your vision with conviction and your assumptions with humility. That's the balance that separates masters from fanatics. So here's what Daniel Kadlec ultimately discovered. These weren't just successful business people. They were psychologists who understood human nature, strategists who saw patterns others missed, performers who could execute under extreme pressure. They were masters not just of deals, but of themselves. And here's the truth that matters most for you. You don't need billions in capital to apply these principles. You don't need access to Wall Street. You don't need an Ivy League education. What you need is vision to see opportunities others miss, and timing to know when to move. In relationships built on genuine trust, in emotional control when pressure hits, uncalculated risk-taking based on real analysis, operational excellence that creates genuine value, conviction balanced with humility. Those principles work whether you're building a billion-dollar empire or a small business, whether you're investing millions or just managing your career strategically. The game is the same, only the stakes change. Conclusion. So, let's come back to where we started. October 13th, 1998, 3:47 a.m. Sumner Redstone on the phone, closing the impossible deal. What made that moment possible wasn't luck. It wasn't just money. It wasn't even intelligence, though he's brilliant. It was decades of disciplined preparation, years of relationship building, months of strategic positioning, and in that final moment, the emotional control to stay calm when everything was on the line. That's what it means to be a master of the universe, not controlling the world through raw power or wealth, but mastering yourself first, your vision, your timing, your emotions, your execution, and then using that mastery to create something extraordinary. Cadleck's book isn't just a history of deals. It's a blueprint for strategic excellence in any field, because whether you're negotiating a billion-dollar merger or a job offer, launching a startup or a side project, the same principles apply. See what others don't. Move when others hesitate. Build relationships others overlook. Stay calm when others panic. Take calculated risks others fear. Create real value others just talk about. Do that consistently over years and decades, and you become a master. Now here's what I want you to do. First, if this video added value to your life, if you learned even one principle you'll actually apply, smash that like button right now. It helps us reach more people who need these strategies. Second, subscribe and hit the notification bell. We are deep diving into series we're building on business strategy, deal making, psychology, and high performance. We're also going deep into books like Barbarians at the Gate, The Outsiders, Shoe Dog, Pour Your Heart Into It, and dozens more. This is a masterclass library we're building together, and you don't want to miss what's coming. Third, drop a comment answering any of these questions. What country are you watching from? We want to know where our global community is tuning in from. Which of the 9 masters resonated with you most, and why? What's your favorite quote or principle from this video? What book should we break down next? I read every comment. The best insights get featured in upcoming videos. This isn't just a channel, it's a community of serious learners who want to master the game of business and life. Fourth, share this video with one person who needs to hear these strategies. Someone building a business, someone making a career move, someone who's hungry to understand how the game really works at the highest levels. Here's the final truth. The masters of the universe weren't born special. They became masters through disciplined study, calculated risk, systematic execution, and decades of refinement. Which means you can too. The question isn't whether you have the potential. The question is whether you have the discipline, the patience, and the courage to develop it. Don't go anywhere. We're just getting started building this masterclass library. The next level is waiting. Let's get there together.